morning, this is Pushpita Dey from the New Indian Express and welcome you to this special pre-budget discussion. With Union Budget 2026 just around the corner, all eyes are now on the government, on what it does in terms of sustaining the growth, boost consumption and also ease the tax burden for individuals and businesses. In the last budget, the government took a clear step towards the relief, relaxing the income tax slabs, widening the rebate thresholds, and also putting more money in the hands of the middle class people. Alongside the recent GST reforms, from rate rationalization to the easing of compliances, have aimed to reduce the friction and improve cash flows for the businesses. But still the big question lies, what more can taxpayers realistically expect from the upcoming budget of 2026? Will there be further relief for the salaried individuals? Can simplification finally take the center stage for direct taxes even for the corporates? To decode all these questions, to understand the risks and the possibilities ahead of Budget 2026, we are joined by two leading tax experts from Deloitte, India. Today we have with us Mr. Sumit Hemkar, Partner of Direct Tax at Deloitte, India, and Mr. Tarun Garg, Partner for Personal Tax. We also have with us Mr. Deepak Mondal, the Editor for the Business Bureau. Thank you, sir, for joining us. The government has already made a lot of changes through this new Income Tax Act. So what do you think will be the other key areas where direct taxes, in terms of direct taxes, where the government can make some more changes in the upcoming budget of 2026?
Look, the whole 2025 law is a new piece of legislation, so there is a lot to look into. But we feel that there are some additional areas that the government can spring a surprise or two, if I may. The first one is, of course, on the international tax reform, which is on the Pillar 2. The expectation is that the government might, put out the legislation on implementation of Pillar 2 in India. We've been waiting for a few years now on that, but maybe this is the year when we start, seeing some strands of that. The second thing that I feel, which is important given our current economic setup and what we see internationally, is maybe introduction of some sort of tax incentives for some sunrise industries like artificial intelligence, something in renewables. Giving some more incentives, impetus to these industries might be important for the next wave of growth and to push the next wave of growth in India. And I feel that maybe there is a little bit of rationalization possible on the rates as well. Possibly for the MSMEs, giving them a little bit of impetus because the government has been particularly careful about, creating reforms which help MSMEs in a significant way to prop up their businesses. So I feel that that's something on the radar as well. And one last thing I feel is maybe a potential case of a wealth tax for the ultra high net worth individuals. That's something that might that's been doing the rounds in discussions, but we don't know if it will see the light of the day. But yeah, that's something that could happen.
So on wealth tax, the last time when it was removed, the government had argued that the effort and the money that goes into collecting it, the kind of collection that we get is not worth enough. Huh? So do you think there is a case for wealth tax still?
Well, if it's just the administrative part, now we are getting into a far more digitally connected world. And transactions are a lot more online now. And there are a lot of additional disclosures that get made, not only through the individual, but also through the setup around that individual. You transact through banks, you transact through cards, you make purchases online. So a lot of additional data in today's day and age is available to the government. So the implementation, I feel, even from a standpoint of expecting compliance from those ultra high net worth individuals is possible.
What should be the ideal threshold for a wealth tax to be?
Oh, that's for anyone to guess. The earlier one was pretty low. I'm hoping that if it is, if at all it sees the light of the day, then it should not be something low as comparable to the last one.
Give us a figure. Give us a number.
Difficult to take a guess.
Maybe see from a individual tax perspective, the way the government did in the Finance Act 2025, already rates have been rationalized. People who are earning, say, up to 12 lakhs, at least on that side, they're not getting taxed. But overall, there are still some areas where we see clarity can be given, especially in terms of the stock options. Because what we see a lot of times, people who are, say, mobile employees and kind of working in multi geographies, there if they turn out as a non-resident in India, and they are getting the stock options from the Indian company, a lot of times there is an argument that how their taxation will work. The grant to vest period that we called as a vesting period. So at least from the provisions of the act, there is no sort of an apportionment principle. We have to rely either on the OECD guidelines and also on the case laws. But then if that is brought in the act itself, that will be much appreciated. Plus, also from the perspective of perquisite valuation for electric vehicles, now that's already there in the market. We see a lot of people now moving away from the traditional petrol and diesel cars to the electric vehicle car. So it'll be much appreciated that if their valuation principles rules are also kind of notified. While we do await the rules to the Income Tax Act, which has been New Income Tax Act 2025, but then let's see whether these are kind of provided for in the rules, or at least the government wants to bring in some clarity. So these are few areas where, at least even from an employer-employee standpoint and the individual perspective, we see like if there are some clarity being brought about.
Incentives about the sunrise industries that you were talking about. This has been a demand for a long time. There was a period for when the new industries were given 15% tax, and that period people kept asking for increasing or extending the deadline, but it has not happened as yet. I mean, two years ago it was over that period. So do you hope to see? I mean, is there a stronger case now? Given the kind of industry that government wants to attract, whether it's semiconductor or AI related.
I feel so. There's always an economic case that can be made or built around some of these industries, like the rare earths piece of the PLI that the government has now come up with. Very laudable as an effort, given the state of affairs that we are in international economy today. I feel rationalization of rates has significantly happened. It could still happen further. Some incentives, the government has moved away from incentives, carte blanche incentives across the board, and several incentives as part of the tax legislation. So they will come back to the incentives topic with a lot more closed scrutiny and careful review. But I feel that there is a case for some of these industries to get some incentive.
Okay.
To usher in the new age businesses into the real economy or the economy that we have at large.
Coming back to your pillar 2 point that you made, I mean, what can we expect from that front?
Well, look, I mean, pillar 2 is part of the 2-pillar proposal that the OECD came out with. Pillar 1 has run into rough waters because of the position internationally of some of the countries, and it continues to remain in that kind of suspended state, if I may. Pillar 2 is more closer to reality. A lot of countries around the world have implemented Pillar 2 as part of their domestic legislation. So if there is a multinational today working across or operating across jurisdictions, even if it is headquartered in a jurisdiction that doesn't implement or hasn't implemented Pillar 2, they still are touched by Pillar 2 in those jurisdictions where they operate and the legislation has been made part of the local law. India has been taking a wait and watch approach on Pillar 2, but I feel that the time is now ripe because there is consensus on Pillar 2. India has also given that, has taken on in itself to align with the Pillar 2 requirement. And I think the time is ripe for the domestic legislation to come in on Pillar 2.
For our viewers, Can you explain Pillar 2?
See, Pillar 2, essentially, the OECD said, look, and this is through the international dialogue that happened for several years now, that any multinational should at least pay a de minimis tax, and that tax is of 15% across any jurisdiction that it operates in. And so if it operates in a jurisdiction in which the effective tax rate is, let's say, lesser than 15%, then some of the other jurisdictions, which is, let's say, the parent or the headquarter jurisdiction, can levy a differential tax so that the overall tax of, including the income from that low tax jurisdiction, comes to 15%. So there are strategies which have been provided for in Pillar 2 that enable another country to tax that differential. Now, if, let's say, that jurisdiction which levies lower tax, if it is not able to collect that tax and that tax is collected by some other jurisdiction, then of course it stands at a disadvantage. So countries have to, bring in that domestic legislation on Pillar 2 so that they can apply a incremental tax if that incremental tax was to be applied by a headquarter jurisdiction instead. So it's kind of bringing at level of a de minimis tax for an MNC to pay across jurisdictions.
Also, we have recently seen that buyback taxes have made into a lot of newses. Recently, we have Narayan Murthy and Sudhamurthy not opting for that. So, do you feel that there will be a strong case for the government to amend the regulation or make some changes in terms of the taxation for the buybacks?
I feel so. Because fundamentally, if you look at buyback tax was applied on companies as a shift from the shareholder to the company, and now it is switched back to as a tax on the shareholder. Now, if you fundamentally look at it, a buyback results out of a purchase of shares back from the shareholders by the company. Now, that is a capital transaction in the hands of the shareholder. If it is a capital transaction, should it suffer a capital gains tax incidence, or should it suffer a regular income tax incidence? Now, the last budget, since the taxation regime for buybacks was shifted from a buyback tax to a dividend-based tax, so it is deemed as dividend without allowing an offset for the cost of acquisition, because the cost of acquisition is allowed as a capital loss. The dividend is taxed at a higher rate as compared to a capital gains tax. So there is an anomaly, at least in the way I see it, that exists in the current manner of taxation of buybacks. I feel it makes up for a case for a potential change.
Tarun, does it come under your purview as well?
Yeah, so at least even from like individuals, and especially I see a lot of HNIs getting impacted. You talked about Narayan Murthy, Sudhamurthy. So see, yes, we have been also seeing the way it is structured. Capital loss, and we see it's allowed to be carried forward for 8 years, potentially years, but will that be consumed potentially? And given the way people are investing in the stock markets, there is more of a profit from the shares that they are selling as compared to the losses and all what we are seeing in the returns that they file. So as Sumit kind of pointed out, it's a case for kind of a change again, because the way it has been shifted as a kind of a deemed dividend taxation, and then the cost of acquisition is a loss. I totally kind of echo what he has been mentioning, that this should be relooked into. And I know there has been multiple times they've changed this provision. So yes, needs to be simplified further.
Simplified. Okay. So, I mean, simplified as in what ways?
So simplified in the sense, what we are seeing is that rather the way it was, maybe from a company standpoint, and Sumit can further add, that provision was still better, or you just straight away kind of bring into the capital gains by kind of shifted back to the dividend, and then the cost of acquisition is being allowed as a loss to be carried forward. Rather, if the shares have been bought back, just straight allowed as a capital gain transaction, and then maybe. So this is a case for discussion again. Like some can be. These are my thoughts. Probably, if there are any other point of view.
But do you think it should be taxed as a capital gains tax, or rather than the way it is?
I mean, it should be. It used to be the case back in the. I mean, it's nothing different. Earlier, it used to be taxed as capital gains. Then the incidence was shifted on the company which was doing the buyback. So that was just a shift of the incidence. The real nature of the transaction remained the same. And now it is deemed as dividend. So there's an artificial color of deeming fiction put on the buyback receipts as dividends, which is like an ordinary income, if I may, right? And that kind of sticks out as a different treatment than what the underlying nature of the transaction, which is a capital transaction. And so I feel there is some level of incongruity which needs alignment. I mean, the whammy for the taxpayer in this case would be that if, let's say, they don't have a capital gain, then that capital loss of the cost of acquisition of the shares which have now been bought back is a dead loss. Right? So they are not only paying tax at a higher rate of 30%, let's say thereabouts, as compared to 20 or 12.5%, but they are also not getting the benefit of the offset of the cost of acquisition, which was actual cost that they'd incurred.
Exactly.
So I think a case for the government to consider.
Since you spoke about capital gains tax, we spoke about capital gains tax. There has been a lot of hue and cry over the last year's change and last year or previous year. Okay, on capital gains tax, it was increased from 10 to 12.5%. People are saying that the kind of FII outflow that we are seeing, it is one of the reasons. I mean, what do you get? I mean, what do you hear from your clients? I'm sure you must have some of those clients who are investing overseas, clients who are investing in India. And do you think that government is in a mood to listen to taxpayers on this?
Look, the capital gains tax regime in India has undergone changes. A few years back, there was this, and that has been the demand that, kind of overhaul the capital gains tax regime. The government has been doing some, taking some actions pretty much in every successive budget. And, the one that we saw on the rationalization of the capital gains tax rates, especially the long-term cap, was basically to align the tax rates for residents and non-residents. So bring the base rate of tax for long-term at 12.5% and the short-term rate at 20% kind of aligns the tax rate between non-residents and residents. One view is that why have a differential treatment between residents and non-residents? Both are equally contributing capital, if I may, right? Now, is there scope for more change? I think there's always scope for change. But I feel the window has now become smaller and smaller.
Okay.
There is a difference now today between listed securities and other types of assets. So you have the 24 months and the 12 months differential in treating an asset as short term versus long term. Debt security is a question point because, and the NITI Aayog also is pushing for debt securities to undergo some kind of change in regime. And I feel that there is scope for doing some bit of changes for debt securities. I mean, to align them to maybe equity, to bring them at par in terms of treatment. Should we have many categories of differential holding periods? The answer is no. But for some kind of assets like immovable property, maybe it's the right thing to do, to not allow too much of, or to not give impetus to too much of trade in immovable property. But that's just a view. So I feel there is scope. There is, but the government has done fair bit over the years to chip out at some of the sticking out points.
Tarun, your thoughts?
Yeah. So like Sumit has already covered. See, from an overall perspective, what we kind of are looking, definitely it has gone a long way. See, earlier when we look at all these long-term capital gains, at least the listed ones, those were completely exempt under 1038. So those have gone away. Those new sections have been brought in. 112A was kind of introduced. And then that's how some exemptions have been increased. Earlier it was up to 1 lakh gain on the long-term securities was exempt. That was increased to, I think, 1.25. So all those things have been done. The government is changing. The overall rationale has been to simplify the capital gains tax regime. There is still a scope for simplification, as Sumit kind of pointed out. In equity versus debt securities, no point of having different holding periods. When we look at even the global perspectives, they are also following a simplified version of the capital gains tax. Some of the jurisdictions don't even have that capital gain tax. Can India afford to do that? The answer is no. But yes, some bit of simplification in terms of aligning the holding periods, that can definitely be done. So that's my view. And even in terms of reportings and all, while the new tax return forms are awaited, and we are hoping that will take away the simplification, because most of the information is already there with the government. So at least that, just if the individual are asked to just post their demat account numbers, and rather than putting in all the securities and all, so that will be a welcome move. So that's my view on the capital gains taxation in Virginia.
So, talking about the NITI Aayog suggestions, NITI Aayog has repeatedly pointed out how punitive the tax system is right now, and they have also suggested for decriminalization of certain things. And the crux of their report has been to set the onus more on the tax authority than the burden
of
proof, basically on the taxpayers. So, how do you think that could be implemented and could be navigated by the government? Any amendments, and what should be?
I think it's a great suggestion that NITI Aayog has come up with, because criminalization, of tax proceedings is actually a little bit of a legal angle to this, where the burden of proof is artificially shifted on the taxpayer himself, which is anyways onerous, and which is different from how it otherwise applies under other legislations. Under the income tax law, of course, there should be some really strict provisions which dissuade taxpayers from taking very aggressive or tax avoidance kind of schemes. I feel that those legal enablements should exist in the law, but they should not be implemented as a routine measure. Sometimes we see, and this is not in every situation, but sometimes we see that some provisions, like, for example, tax withholding, if there is a default in deposit of tax withholding for some administrative reason, and if you don't see that as part of the regular operations of that taxpayer, then should that taxpayer be put in the dock under criminal proceedings? When it was clearly not the intent. Sometimes some of these provisions get applied in a very routine manner, and I feel that is something that we should stay away from, because that antagonizes the taxpayer. These kind of proceedings, criminal proceedings, can actually upset the whole rhythm of thought process of a corporation per se. And we have a lot of multinationals. The whole legal system kind of wakes up when a notice relating to criminal proceedings gets issued. I feel there is need for decriminalization. I think the government has done a whole lot in decriminalizing a lot of offences under a number of legislations. I feel a little bit more under the Income Tax Act is also going to be welcome.
And taking a cue from what Sumit has mentioned, see, even in the last few years, last year budget also, the government made some bit of changes, at least in the TDS deposits perspective. Like earlier, if you have deducted the tax but not deposited, even 1 day default was considered as a crime, and then you could be asked question, and then you have to go after compounding and all. So at least those rationalizations have been done. At least they've given 3 months. But yes, lots of things to be done. There is, as Sumit pointed out, there is an inherent concept of mens rea under the income tax legislation, which means the onerous proof is on the taxpayer rather than the authorities. But is it now prevalent in the other legislation? The answer is no. The government is already moving towards decriminalization. And like you would also see in the labor codes, the new labor codes that have been enacted, implemented, there is a concept of inspector cum facilitator. Again, like inspector cum facilitator, they have brought in this from the likes of the overseas jurisdictions. We see this concept in Canadian law and Singapore. Even the ILO had suggested that. So now the overall kind of intent for the inspector is that he will be in a dual role. He can't just straight away levy penalties and all. And there is a concept of improvement notice also that they've brought in, that the establishments will be given an opportunity to ask that if there is any compliance challenges that they're facing, why that compliance was not met. So there is always an opportunity being given to the establishment, but does that mean that you do offenses repeated and all? But the answer is no. Like for any repeat offenses, there are stricter and severe penalties even under the labor code. So I would echo what Sumit mentioned, that there are kind of things and ways and means that should be kind of amended in the income tax legislation too.
On TCS and TDS, I mean, every year government does a little bit on TC, making it less complicated. But there is scope for more, simplification of the way TCS and TDS is, levied and charged. Your thought? What else can the government do?
I mean, there could be a lot of radical things that, one could be that, just have a standard set of rates for certain types of categories of transaction, like the goods and services tax kind of puts out the categories of transactions as transaction in goods and transaction in services. That's it. I mean, TDS could take a cue from that, and there could be a TDS on goods and TDS on services, just two rates, and you're done with this, right? Keep the rates only as a matter of compliance.
Right now it's 6, I guess.
Yeah, I mean, there are varying rates. The rates vary from 1% or 0.1% because there are some sections, right up to a very high rate, over to 20% potentially. So I'm saying that takes away the burden from the deductor, who's actually, discharging a vicarious liability, because it's not his tax, it's the tax of the recipient of the income. And he just has to deduct and report so that the government, one, knows that there is a certain amount of income that is earned by a recipient, and that tax is collected as the income is earned. Now, if the tax is collected on gross amount, the tax rates can be low. And I feel the 1%, 2% rates are the rates for us to keep it progressive and keep the compliances non-onerous on taxpayers. See, taxpayers anyways have the obligation, even if the tax withholding is lesser than their ultimate tax liability, they have an obligation to deposit advance tax, self-assessment tax. So every taxpayer will be vigilant, because otherwise they incur interest costs. So the vigilance will be there once the reporting happens through the TDS. And anyways, with GST now in full flow, the reporting of most transactions is very formal, and therefore the government has the data to track transactions. It's not the yesteryears where transactions could happen without the government knowing.
Yes.
So I feel there is a case for rationalization, further rationalization. In the 2025 law, they've simplified by putting it all in one place in as part of a schedule. I hope in the coming years we see even a further curtailed or a smaller schedule, so that we have much more simpler regime for the deductors.
So on that reminded me of the government has a certain TCS, right, on crypto transactions, 1%, and they have a tax on 30% on crypto gains. Do you think things have changed a bit? The thinking about cryptocurrencies earlier RBI governor was very against. He was against crypto completely. But now I think there has been some changes on how to treat cryptocurrencies. Do you think there should be some changes in crypto taxes? If 30% tax is very high, or the TCS of 1% is very high?
I think it's a case of evolving thinking. I think we will all evolve, including even the administration. We will evolve to appreciate that there is a parallel world of
virtual currencies.
The more that comfort level increases with that parallel system of settlement or parallel system that exists today, in some a little way, maybe some of those changes will start emerging and acceptability will start emerging. But at this time, I feel that maybe that level of maturity is not there, and maybe therefore the inhibition that should we allow this blatantly, openly or not, remains a question.
Okay. Then one question. So I was going through the demands, basically demands of ICAI, Institute of Chartered Accountants of India. So they have made a very interesting demand that government should introduce an optional joint taxation of married couples. I don't know if you're aware of it.
Yeah.
So how do you find this idea?
So see,
And why do you think this thinking?
Yeah, so let me just call out. See, why the reason, and free, whenever any kind of a suggestion comes, there is some backing to it.
Yeah.
So when we see the other countries, especially the US, there is a concept of a joint filing, married kind of couples filing. And the reason they have kept it like there is and even there is a unique concept of a family filing. If you have your children also, you can show them together and then they can file a single return. Of course, their social security numbers are posted in that returns, and then the kind of filings are done. Now, the reason, there is an interesting logic behind this suggestion. See, the reason is that, look, married couples, a lot of times they are having joint holdings, joint properties, investments and all. Now what happens is like sometimes the spouse is not earning while the husband is kind of done with that investment. So in both the tax filings, you have to do the reportings of those assets. If these are foreign assets, you have to do like who is the beneficial owner, who is the actual owner. And then a lot of times those scrutinies are also kind of picked up. One other aspect is that, look, the husband is the actual sort of the person who has invested into the assets but has taken the property in the name of the spouse. And then the spouse has rented it out, that property, and leading to the fact that the rental incomes are coming in spouse's name. And the TDS is also getting deducted in the spouse's name. While they have changed that anomaly because there is a clubbing provision clearly that will get triggered. So that income will have to be offered in the spouse's, the husband's name. And so those provisions have been amended. Now, even that return, you can show whatever TDS or has been withheld in your family's name, say a minor child or a spouse. But then I would agree that if that concept of a joint filing is introduced, one, it will eliminate like unnecessary dual reportings and all. And then you can always give that option. Even if the married couples want to file separately, that can be done. But then introducing this will lead to an ease of compliance burden, is what I feel.
Similar to similar to individuals, countries also have a consolidated tax filing for corporates.
Corporates, yeah.
And under that kind of a scheme, broadly, the parent company can file tax returns, which is a single tax return for the entire group in that jurisdiction. It simplifies the framework for, of course, the tax return is a complicated return because it absorbs the but a lot of the intercompany transactions get evened out. And intercompany transactions also stop getting reported as a dually taxed income in a way. So it has its benefits and it will simplify things because, instead of having, let's say 30, 35, 40 returns, you would have just a single return, which the government has to look at. Will help even doing tax assessments in a better, more qualitative way. I feel it's, the time is ripe for us to even consider that as an option for taxpayers in India. Because the Indian promoter groups, Indian companies are doing very well today and they are expanding internationally as well. They're developing structures which require them to have multiple entities for a particular line of activity or a business. I feel it's something for us to consider, even if it's not implemented as part of the current budget or next couple of budgets. But there's a conversation that must happen around it to see if it's really a fit case for India.
But don't you think both these ideas should have been in the Income Tax Act?
Well, the framework of the law 2025, which the government set out, and what the committee was required to do was a very specific one, which was to simplify the legislation.
Okay.
Any changes that have happened are purely incidental. That was not the idea.
Okay.
So it's a simplification drive that has driven and given result to the 2025 law. Any changes, like I said, will happen through amendments.
Government so far has kept this bilateral investment treaties out of the tax ambit so far. So do you think there could be any development in terms of the BITs going forward? Because we are having a lot of trade agreements and trade talks with so many countries these days. So keeping that in mind.
Yes, I think so. I mean, there are a number of trade agreements that India is currently negotiating with a number of countries, given especially what's happening on tariffs across the world. I feel that the time is good also for the government to keep relooking at the bits with countries, because it gives some level of confidence to even investors that their investment will have a framework support of a BITS, because then an investor has his eyes and ears open on the context of that investment through the BITS. And if there is a problem, difficulty that they face, then they can approach the respective authorities under the BITS framework. So I feel it's always good to give better level of clarity through an implemented tax treaty or a treaty like a BITS, so that investors are clearer about certainty is always better than keeping the taxpayer in the dark about what he or she might come across.
So I get to hear. I mean, there are these reports that says that taxpayers are getting a lot of tax notices because of their foreign assets, because they're not disclosing the foreign assets properly. Why is this still happening, and why is there? I mean, do you think there is a lack of awareness on that?
So let me take this up. So see, the reason for that is it's primarily twofold. Like definitely it is there in our Income Tax Act, and foreign asset, the way they had introduced, it's not a new concept now. It was introduced way back in 2011 onwards, the way they had introduced it. And why it was introduced? Because majority of the other legislations and other countries legislations have already kind of done that. Say US FATCA laws, they are also asking the properties which are outside of US to be reported. Similarly, so the India also found that requirement to be there. And that's how they amended the Income Tax Act, brought back the fact that people who are turning out to be an ordinarily resident, they have to report their overseas assets. Now, again, thereafter a Black Money Act provision kind of came in, which mandated that like there will be stricter penalties if you're not reporting your overseas assets. To some kind of concession was there, like if you have a bank account and the balances in the overseas bank account is not that huge, say up to say 1 million, then that penalty clause was not getting triggered, because it's a very severe and harsh penalty under the Black Money Act of approximately 10 lakhs and so yeah. So see, that's the reason. Still I would say amongst the individuals, either due to ignorance, they're not reporting it, but the way the authorities are exchanging data under double kind of information exchange agreements and all. So these information becomes quite visible now, and the authorities are having that data. So lots of times these assets either get omitted to be reported. I am not saying there could be no kind of malified intention, but then yes, sometimes due to lack of awareness or maybe lack of availability of data, or in a hasty manner that the returns filers want to complete their tax returns on time, and given the fact that now the timelines have been curtailed, plus the fact that the revised return, belated return timelines are also within that closure of that calendar year itself by 31st December. So a lot of times these gets missed to be reported. So it's a perfect case the government consider at least extending the timeline for a belated or a revised return. They have introduced the concept of an updated return, wherein they are giving a 48 month window if you have kind of missed some income to be reported therein. So yeah, so all those aspects may be considered.
Although not directly related to the budget and income tax, but we recently had this labor code which proposed a lot of changes. So if I could just ask, what do you think will be the visible change in the salary structure, and at all will there be any increase in the enhanced salary of the individuals who are employed? No.
A very well kind of asked questions, at least in our times. So, see, what is happening is labor codes, the government, it was always there, in the sense that code on wages was passed in 2019, and then the other three codes got kind of passed and was assented by the President of India in 2020 onwards. And what the government has done is they've just implemented it. It means that they've just pressed that button. So no change, at least in the legislation front. Of course, there will be rules, guidelines, notifications, bylaws to be prescribed. Now, from a salary perspective, why the individuals are seeing a lot of changes coming It's because of twofold. The way the wages definition has been prescribed under the labor codes. It's the central figure of the labor codes, cutting across all the four codes, which means the way, like under the gratuity legislation, the basic wages and the dearness allowance was the wage on which the gratuity was to be computed. But now, under the new labor codes, there is a embargo, or there is a caveat that your total wages can't be lesser than 50% of your overall CTC, which means come what may, the salary on which the gratuity calculation shall be done, it has to be 50%. So earlier, if it was say 35 or a 40% basic, the gratuity was accordingly getting computed on that. So 4.81% of say 40% is basic. Now it will be 4.81% of 50% or even more than that. So it will lead to a slight reduction in the take home pay if the gratuity is a part of the CTC. If that is kept as outside CTC, we are not foreseeing any visible change in the take home pay. The reason being, see, Provident Fund any which ways is driven by a statutory wage ceiling. The current wage ceiling is 15,000. So which gives an option to the employees, like subject to the wordings in the employment contract, you can very well contribute up to that level or even to the basic salary level. You don't need to contribute PF on the salary. So again, subject to this gratuity, we are not visibly seeing a much change or a dip in the take home pay. But yes, overall the contract, the language and the verbiage that's used in your employment agreements has to be kind of seen.
So thank you so much, both of you, for those enlightening vision and insights and what we could more expect from the upcoming budget.
Thank you.
Thank you so much for watching us. Please do let us know, what do you expect from the upcoming budget? Do you really think we can have further relief, or what more to expect from Budget 2026?